Welcome. You're watching the newsroom right here on ET Now. I am Ajay Sharma. Well, it's turning out to be a day of profit booking, but mild profit booking is being seen, not huge gashes of the market. In fact, if you look at the wider stocks, you will see that there is buying which has actually come in the wider group stocks. Just the larger cap are relatively quiet today. So we thought of getting you a very special voice today. Rana Gupta, who's an FII, joins us for perspective on how foreign investors are looking at the landscape. Remember, they've bought over 6,000 crore in October till date. And in general, the tides seem to be turning in favor of emerging markets. So how does India stand among the emerging markets? We'll discuss with Rana Gupta, who's joining us all the way from Singapore. Rana, good morning and thank you so much for your time.
Good morning, Ajay.
How is Manulife analyzing the emerging market investing landscape right now? How is the recovery panning out in your observations, the data points which you are reading?
So the emerging market investment outlook looks quite promising. If you look at the broader emerging market universe, particularly in Asia, the recovery that we have seen in China is very encouraging. At the same time, the kind of recovery we see in the developed world, they were encouraging, but there's some signs of stall out. But we believe that there will be more help on the fiscal and the monetary side on the way. That also, in a way, augurs well for the emerging market complex. And within emerging markets, China and India are two larger ones. So we do believe that in the current scenario, the emerging market investment scenario looks quite promising. The recovery in China is very good. And we believe, as far as India is concerned, the worst is possibly behind us. Going forward, things should improve.
Rana, if that indeed is your observation, how are the markets pricing in this recovery? How is the different pockets of the market in terms of the large cap companies, the mid cap, broader markets? What's your analysis on the valuations or things which are getting priced in now?
Right. So I think, talking about what is priced in, what is not, is a bit difficult or challenging at the moment because we are at a cusp of a turning point. So going forward, I think if you take a 1 to 2 year view, and if our assumption on vaccine rollout, etc., pans out, you are looking at a fairly strong recovery led by capital flows coming in, led by lower interest rate, adequate liquidity, credit growth picking up. So the recovery could be quite strong going forward in next 1 to 2 years, and earnings could reflect that. So at this point, it's a bit challenging to say what is priced in, what is not. Having said that, we can always look at the companies or other sectors where the pessimism is still very large, right? For example, India's private sector banks, they have been underperforming. And if the recovery pan out as we are hoping or expecting, in that case, the credit cost, which is the market fearful about, may not play out as much as the market is fearing. So that would turn out to opportunity. So we can say rather there the recovery is not priced in. The recovery is also not priced in, let's say in the some of the transport or the leisure stocks, but there they will be later cycle beneficiaries. I think something like a private sector banks, select auto stocks, there I think the recovery is not priced in. I think that is more easier to say.
Rana, before I talk to you in detail about your sectoral preferences or avoids, I want to understand, you've been a market watcher and a practitioner and have seen a lot of cycles in the market. If you look at the last few economic recessions or busts and then gradual recovery setting in and how markets are priced in, what stage of the cycle are we right now? The way governments and central banks are putting in recovery efforts and the way markets are pricing in it. Do you see 2-3 year structural repair work in the economy and hence earnings trajectory coming back for market and for corporates, or you think right now the visibility is relatively lesser?
No, I think let's take a step back. I think what we have been highlighting also, that there have been many things happening for last 4 or 5 years, and that is where the earning growth has been quite pedestrian, because when a structural shift happens, the growth and earning growth suffers in the near term. So if you go back to, let's say, 2015, 2016 or thereabouts, formalization started. And this formalization has led basically the groundwork for what we are now experiencing, digital India. This digital India or digital economy would not have been possible without without, let's say, online way to identify yourself through Aadhaar card or linked mobile phone, linked bank accounts, and the 4G network. So we are seeing the digital economy picking up as a result of that. Then I think last year in September, about a year ago, there was tax cuts announced on new investments. Now you add to that with import duties, some of the import duties going up, some of the production link incentives coming through. That makes us sure the government is trying to push manufacturing as a percentage of GDP. So better manufacturing, better digital economic progress. Those things are more medium to longer term. Even in the shorter term, even in the short to medium term, we have a very benign base because of the COVID thing. Everything was shut down, and so we are building a very benign base. At the same time, all the economy has contracted. You have seen the money supply growing thanks to capital flows, thanks to RBI's accommodative stance. As and when the fears recede, and which we believe it will, and the bank's asset quality troubles are within the expectations zone, we believe that going forward, you will have credit growth picking up. So even in the near term, even the cyclical part of the economy picks up. And I mentioned the digital and the manufacturing are the more medium to longer term drivers. So as far as we are concerned, we like that story, and we think it's 2-3 year visibility is there.
Right. Rana, let's talk about sectors a little more in detail. The economic recovery trades, deep cyclicals, auto ancillaries, banks, NBFCs, and to a certain extent capital goods also, were the most hated March, April, May, June onwards. But there seemed to be some life coming back to them. How are you looking at these sectors which are correlated with the economy?
Certainly, I think we quite like the auto and auto ancillary space. Now, auto space should recover with the economy, and also there is an additional layer of preference for personal transport post-COVID. So I think that should also help. So auto sector is one sector which we like. Within banks, the private sector banks and select NBFCs also we like. Even within financials, there are certain companies who are also linked to the beneficiary of the growth. For example, if you think about credit cards, general insurance, they also tend to do well with economic recovery. So we like that part also. Capital goods comes a bit later in the cycle because currently the reason why we are expecting faster profit growth is because today, as we speak, the capacity utilization is low. That's why to get the additional top line, the companies need not put in the additional capex as yet. That's why profit growth will be faster. And that's why we like more auto and the banks kind of cyclical stories. But going forward, let's say 6 months, 9 months, or 12 months down the line, when the capacity utilization picks up, maybe that is a point one should be looking at in industrials or capital goods.
Right. Rana, the favorite of the market, March onwards, or I would say a little early, pharma got identified a bit early, but now IT is also 1.5 decade high, and IT and pharma people are finding a lot of comfort to the extent that select pockets, the numbers, the stock prices may have run a little ahead of the numbers. How are you analyzing this, kind of a emergence of IT and pharma in the last 1 year? And what's your own position here?
Sure, I'll talk about IT in a bit, but let me address the issue on pharma. And I'm clubbing pharma and chemicals altogether. Recall what I discussed about the medium to longer term issues, digital Indian manufacturing. Now think of manufacturing, right? Manufacturing is somewhere where it's across sectors, and chemical and pharma is one integral part of that. So we are seeing in chemical and pharmaceutical sector, Indian producers, Indian manufacturers are gaining global market share. Again, it's a structural story, and when we speak to all the multinational companies, they're all looking at China plus one strategies, and their interest is squarely within to Indian companies. So this is one story where the Indian companies can keep gaining market share, and could be this story can play out over a period of time. Coming to IT, of course, the 1 or 2 companies reported results. The results were quite good actually. The margins were much better, but the IT sector, some of the companies, they have had a very decent performance in terms of stock prices, and IT is one sector where the earning growth, it's surprising, but some of the expectations now started to get built in, as we have seen in some of the stock price reactions. So I think IT is somewhere there we would be neutral to positive, and whereas the pharma and chemical is concerned, I think there are scope for more upsides, and as we've discussed, this could be a pretty structural story for years to come.
Right. Rana, I'm also curious to know from you, how would you play the Atmanirbhar theme which is emerging, or China plus one, if you will, because a lot of companies we know are discussing renewed bigger orders with China from overseas clients, because those clients are moving some sourcing away from China. At the same time, here in India, there is impetus coming in from the policy side on electronics and many other sectors. How are you analyzing this entire two issues coming together, and how would you play that in your portfolios?
Oh, this is again pretty much in line with our manufacturing theme. I mentioned the manufacturing theme cuts across sectors. The bigger opportunities, or rather, where we have already seen some traction, and it is perhaps, if I may use the word, in a takeoff stage, would be in the electronics, in the consumer durables, and in the chemical space. Here, India is to import a lot, so I think the first opportunity was and still is in import substitution, getting the domestic production up. And as the volume builds and the fixed cost falls, the opportunity is also to serve export markets. And this is again just about started. So we see quite a long growth runway in electronics manufacturing, in the consumer durables, white goods manufacturing, or their ancillaries. You can call them, EMS companies, electronic manufacturing services companies. We see this opportunity in chemical companies. We also see these opportunities in light engineering companies, and also some of the auto ancillary companies who operate out of India.
There are a couple of things which lie ahead, like the US elections, whether there's a risk of second wave emerging or not. How are you analyzing all these risks or some wrinkles? How are you building in margin of safety in your portfolio? What are you watching out for on the risk side?
See, on the risk side, of course, as you mentioned, second wave is a risk. So that is one thing we have to be cognizant about. However, our view is that the second wave, even if it happens, there will be no national lockdown. So now I think it will be managed through more regional lockdowns, better therapeutic treatment, better awareness, and a whole host of other things. So that is something which we are watching for that. Second is US elections. Now, US elections' view is that as long as the election gives a decisive verdict, whether it's for President Trump or whether it's for Biden to become president, the risk on sentiment will be all right. A contested election will hamper the risk sentiment. But of course, our base case is that most likely you will have a decisive outcome, and that is something which will be still constructive for the risk on sentiment for the emerging markets.
Right. Rana, before I let you go, the last decade truly belonged to the developed markets. Do you think there's a strong case building that this decade, 2020 to 30, could actually belong to emerging markets? And how does India fare? How promising does it look? If one were to look at the 3 to 5 year kind of a horizon, do you think 12 to 15% CAGR from a basket of stocks is conceivable?
I think for India's position from a 3 to 5 year, from an emerging market perspective, within India's perspective, a 3 to 5 year outlook is quite bright, because as people come back to emerging markets, there are among the large emerging markets, there are North Asia markets, and then there is in India markets. So I think that is one big consideration. I think any investors will look at that. And on the top of that, I think as you would have seen, that India is getting a whole host of foreign direct investments in various sectors. So this pickup of these two themes that we discussed, a digital India and manufacturing in India, these have very long growth runways. And we continue to expect foreign investors, whether it is FDI, whether it is FPI, investments to kind of pour into these two segments. Now, also think about how these two segments impact the economy. Formalization pushes digitization. And then the companies realize, who are still informal, that if they do not digitize, they will lose out. So digitization in turn pushes formalization. In case of manufacturing, it creates well-paid or more organized sector jobs. And ultimately, when the government gets more revenue in the forms of tax, hopefully they will be able to build better infrastructure which will attract more investments. So this is the virtuous cycle that we are thinking will play out. And if that's the case, I think as an emerging markets, the prospect for 3 to 5 years looks quite bright.